A single Las Vegas casino can lose $10 million in one weekend and still walk away happy. That sounds impossible until you understand the machine sitting behind those flashing lights. Because a casino was never really built to win every bet. It was built to make sure that, over enough time, it simply cannot lose. Step onto the floor of a major strip resort, and you're standing inside one of the most carefully engineered profit systems ever designed. There are no clocks. There are no windows near the tables. The carpet patterns are busy enough to keep your eyes moving instead of resting. Every one of those choices was tested, tweaked, and paid for, because the casino isn't gambling with you. It's running a business, and the house edge is simply the interest rate on that business. Take blackjack. The house edge there might sit around 1%. Roulette can climb past 5%. Slot machines, the real workhorses of the casino floor, often run edges between 8 and 12%, sometimes higher. That means for every $100 fed into those machines, the casino can expect to keep somewhere close to $10, hand after hand, spin after spin, for millions of spins a day. Individually, that's almost nothing. Multiplied across an entire resort, it becomes a river of cash that never stops flowing. But here's the part most people never think about. Opening a resort like this costs a fortune before a single card is ever dealt. A major strip property can run anywhere from $1 to $5 billion to build, and that's before the marble floors, the imported chandeliers, or the celebrity chef restaurants. The gaming license alone can take years and tens of millions of dollars to secure. Vegas doesn't let just anyone open a casino, and that's exactly the point. The barrier to entry is so high that once you're in, you're protected from most competition ever showing up next door. So how does a casino turn that staggering upfront cost into a business that prints money for decades? The answer is that gambling was never really the product. Gambling is the funnel. Walk through any major casino and notice what's actually surrounding the tables. The five-star restaurants, the nightclub charging $300 for a table, the residency show with tickets starting at $200, the retail corridor lined with luxury brands. On paper, these all look like separate businesses. In reality, they're satellite operations built to capture every dollar a guest might otherwise spend somewhere else in the city. A resort's total revenue is often split almost evenly between gaming and everything else. And in some of the biggest properties, non-gaming revenue has actually overtaken the tables. That shift explains why a company like MGM Resorts can post annual revenue north of $15 billion, while the casino floor itself contributes less than half of it. The hotel rooms, priced dynamically like airline seats, can hit $400 a night during a big fight weekend. The nightclub alone can generate more profit per square foot than the entire gaming floor. Vegas didn't get bigger by doubling down on gambling. It got bigger by turning itself into a 24-hour spending environment where gambling is simply the entry ticket. Then there's the part the industry rarely advertises out loud. The whale. A single high-stakes gambler betting hundreds of thousands of dollars a hand can single-handedly make or break a casino's entire quarter. These players are flown in on private jets, housed in suites that cost more per night than most people's rent, and treated like royalty, because the math justifies it. A casino might comp a whale's entire trip, worth 6 figures, purely on the statistical certainty that the house edge will eventually claw back far more than that investment. It's not generosity. It's the most calculated form of customer acquisition in the entire hospitality industry. Of course, none of this comes without risk. A casino's biggest threat isn't a losing streak, because over enough hands, the math simply doesn't allow that. Its biggest threat is variance concentrated in one place. One whale getting unusually lucky at the exact wrong moment. Or an entire high roller segment disappearing overnight, like what happened when international junket operators pulled back sharply from certain markets. Add in the brutal overhead of running a resort this size, the electricity bill alone for a major property can stretch into the tens of millions annually. And you start to see why so many casinos have gone bankrupt, despite sitting on what looks like a guaranteed money machine. There's also the mistake almost every failed casino operator makes at some point: chasing size before securing the math. Building bigger, flashier, more expensive resorts without first locking in the customer base and the operating margins to support them. Some of the most spectacular collapses in Vegas history weren't caused by bad luck at the tables. They were caused by debt taken on to build something the market wasn't actually ready to fill. So when you strip away the noise, the neon, the free drinks, the illusion of luck, a casino is really just an insurance company running in reverse. Instead of collecting small premiums to cover rare, catastrophic payouts, it collects small losses from millions of bets to fund a handful of enormous, headline-grabbing wins. Both businesses are betting on the same thing: that the math, given enough time, always wins. And that's the real reason a casino can lose $10 million to one lucky night and still close the books smiling. Because it was never betting against luck, it was betting on time.